Hello everyone, welcome back to the channel. Synergy Business Advisors Noida, your trusted business mitra, helping you stay informed on important legal changes affecting businesses. Hello, when a company enters insolvency, every transaction comes under the scanner. But here is a critical question. Can a simple accounting entry be treated as a transfer of property? No money moved, no asset sold, yet still a legal issue arises. Case introduction. This important issue was examined by National Company Law Tribunal in the case of Atul Bahulal Brajapati versus Suhash Dinkar Bhatta. This case arose during the liquidation process of a company under the Insolvency and Bankruptcy Code 2016. While examining the books of accounts, the liquidator noticed something unusual. Certain receivables, meaning money recoverable by the company, were reduced, adjusted, or completely written off. And this triggered a serious legal concern. Was the company giving an unfair advantage to certain parties just before insolvency? Background of the case. During liquidation, the liquidator conducted a detailed review of the financial records. It was discovered that amounts which the company was entitled to recover were either reduced, adjusted, or written off. But here is the key point. All of this was done only through accounting entries. No actual cash was received, no transaction took place, no asset transfer, and yet the company's rights to recover money simply disappeared from the books. This raised a red flag. Was an undue benefit being given to certain parties? The big legal question was, so the key issue before NCLT was, does an accounting adjustment count as a transfer of property? Or is transfer limited only to actual movement of money or assets? Understanding section 43 of IBC. Before we move to the judgment, let us quickly understand the legal provisions involved. Section 43 of the Insolvency and Bankruptcy Code 2016 deals with preferential transactions. It states that a company is said to give preference if there is a transfer of property or an interest thereof for the benefit of a creditor, surety, or guarantor for an antecedent debt. In simple terms, if a company before insolvency gives an undue advantage to one creditor over others, that transaction can be reversed. NCLAT's key observation. The tribunal gave a very important interpretation. Transfer is not limited to physical movement of money or assets. Instead, it includes extinguishment of a right, reduction of a claim, relinquishment of receivables. In simple terms, even giving up the right to recover money can amount to a transfer. What this means, a receivable is an asset of the company. If the company reduces it, writes it off, or gives up its right to recover, then the other party gets a benefit, and that benefit is treated as a transfer of property. Final judgment. The National Company Law Tribunal, Appellate Tribunal, clearly held Transfer under section 43 is not limited to actual money movement. Even accounting entries can amount to transfer, reduction or extinguishment of receivables, transfer of property. Therefore, such transactions can be challenged as preferential transactions. Practical impact. This judgment has a major impact on how companies handle their books. Now, even the book adjustment can be questioned. Companies cannot hide preferential treatment through accounting tricks. Liquidators get wider powers to review transactions. So remember, in insolvency law, it is not just about money flow. Even books entries can change rights and therefore create legal consequences. This is C&IP Praveen Agarwal thanking you for watching. I hope this presentation will be helpful. Please subscribe to the channel for more such informative videos. Thank you.